You know that feeling, right? You pull up your trading app, you see a wall of red, and your stomach just drops. That's kind of been the mood lately, with headlines screaming about a tech meltdown. And let's be honest, since a few of these giant companies basically are the market now, when they get a sniffle, everybody else gets pneumonia. It all boils down to one huge question. Is this the time to bail, or is this the Black Friday sale we've been waiting for? Today, we're going to cut through all that noise and find out, focusing on the big dogs, the Magnificent Seven. And it all started with this one brutal number. After hours, Amazon's stock just cratered, down a whopping 11%. Now look, when a company the size of Amazon trips, it doesn't just stumble. It creates a shockwave of fear that ripples through the entire market and makes investors question everything. And boom, just like that, the media had its story. This quote here really nails the vibe. It wasn't just about Amazon anymore. Suddenly it was a tech rout, the party was over, the sky was falling. But hang on, is the panic actually based on reality, or is it just noise? Let's dig in. So what exactly was the spark that lit this fire on Wall Street? Well, it all came down to a single announcement from Amazon. An announcement that sent chills down the spine of the tech world and dragged a bunch of other giants down with it. Okay, here it is. The reason for all the drama. Amazon said it's going to spend a mind-blowing $200 billion on stuff in 2026. To put that into perspective, the experts on Wall Street were thinking it'd be more like $146 billion. That's a $54 billion surprise, and almost all of it is being poured into building out their AI capabilities. Now, investors looked at that number and they didn't see the future of technology. They saw a giant bottomless pit for cash. And because Microsoft, Google, and Meta are all on similar AI spending sprees, that fear just went completely viral. So this is the point where most people either slam the sell button or they just freeze up, totally paralyzed. But this is also the exact moment where the smartest investors take a breath, step back, and start to separate the signal from the noise. First, let's define noise. In investing, noise is the 24/7 news cycle screaming, "The sky is falling." It's the daily up and down of the market, the scary headlines, that gut punch you feel when you see your portfolios down. It's all designed to make you panic and do something emotional, like sell at the worst possible time. And then, on the other side, you've got the signal. The signal is the real story. It's the fundamental truth about a company. Is it actually growing? Is it profitable? Does it have a real competitive advantage? Remember that $200 billion spending plan from Amazon? The noise is the stock dropping 11%. The signal could be that Amazon is building an unstoppable AI fortress for the next decade. See the difference? And this chart just lays it out perfectly. The panic seller sees the market drop and is thinking, I'm losing everything, while the analyst with a plan is looking at the exact same screen and thinking, ooh, a sale. My favorite companies are cheaper today. One sells to stop the pain, the other buys because they see an opportunity for huge returns down the road. It's the same reality, just viewed through two totally different lenses. Okay, now that we have our signal versus noise goggles on, let's actually put them to work. It's time to give the Magnificent Seven a quick checkup and see if we can find the real signal hiding under all this market chaos. All right, don't get scared by the numbers. This table is our signal detector, and it's simpler than it looks. Let's just focus on two key things. First, forward PE. That's basically the price tag, how much you're paying for the company's future profits. Then you have the PEG ratio, which is even smarter. It takes that price tag and asks, yeah, but is the price fair for how fast the company is growing? A PEG around 1 is considered pretty good, like a fair deal. Much higher and you might be overpaying. So let's see what we've got. Whoa. Okay, let's just start with the number that practically jumps off the screen and smacks you in the face. Tesla's forward PE is 367. Let me repeat that, 367. That means investors are paying $367 today for every $1 of profit the company is expected to make next year. When you see that next to the fact that its earnings are actually going down, you can see why the valuation is labeled extremely high. That's a signal of some pretty serious risk. Now, what about Apple? A fantastic company, right? Rock solid. But a PEG ratio of 5 is a bit of a caution flag. It suggests the stock's price might have gotten a little ahead of its actual growth. Basically, you're paying 5 times what might be considered fair value for its growth. That doesn't mean it's a bad company, not at all, but it could mean it's a riskier investment at its current price compared to others on this list. And this chart just makes it crystal clear. Not all of the Magnificent Seven are in the same boat right now. On one end, you've got NVIDIA, just on an absolute rocket ship with over 60% earnings growth. Then you have Amazon with slow and steady growth. And then, well, then you have Tesla with earnings actually shrinking by 40%. This is the kind of signal that helps you separate the hype from what's really happening under the hood. So, after all that, after sifting through the data and cutting through the panic, where are the real bargains hiding? What's the bottom line here? Well, a pretty clear picture actually starts to emerge from all this chaos. Okay, let's put it all together. Based on this data, Microsoft and Alphabet are looking really interesting. They're both labeled undervalued and they're posting fantastic growth numbers, over 28% and 31% respectively. And then, get this, Amazon, the very company that started this whole panic, is also on the undervalued list. This could be a classic case of the market freaking out over short-term news. And finally, Meta looks pretty solid too, labeled fairly valued with a really healthy PEG ratio. At the end of the day, it all comes down to perspective. Market panics are like thunderstorms. They're loud, they're scary, and they make you want to hide inside. But they always pass. A company's real value, its fundamental strength, that's the foundation that's still standing long after the storm is over. The trick is to focus on that foundation, on the signal, and not on the thunder and lightning of the noise. So I'll leave you with this question. While everyone else is glued to the headlines, panicking about what the market's doing today, what game are you actually playing? Are you reacting to the chaos of next week, or are you investing for the next decade? Because how you answer that question is what turns a day like this from a disaster into a massive opportunity.